Hi everyone, welcome to the YouTube channel of Connecting Minds. In this episode, we will discuss and understand some concepts related to the sale of assets, be it land, buildings, residential house properties, etc. from an income tax point of view. I had already discussed in episode 3, which is on the basics of income tax, that at the time of filing your income tax return, you need to show income in the form of salaries, income in the form of rent from house property, income in the form of profits or gains from business or profession, and yes, income from the sale of capital assets shown under the head income from capital gains. Well, if you haven't watched that particular episode, I've given a link to the same at the end of this video. So before we jump into the tax implications for income under the head capital gains, it's very important for us to make our foundation solid, and therefore, firstly, we'll try to understand the term capital assets. Well, to put in simple words, a capital asset is property of any kind, be it movable or immovable, tangible or intangible, whether used for a business or not. It includes all kinds of assets. But like always, you have certain exceptions to the term capital assets. First is stock in trade, be it your raw materials or the work in progress stock or finished goods. Income from the sale of stock in trade is more in the nature of business income and not income from the head capital gains. Second, and the most important exception, is personal movable property. Take a look around and you will find that personal movable property includes cars, bikes, laptops, watches, mobile phones, tablets, and these are not termed as capital assets, which means there'll be no capital gains arising on the sale of these assets, and hence there'll be no capital gain tax. The third exception is agricultural land in rural areas, which is also not a capital asset. Well, the section also provides that in the category of personal movable property, jewelry, drawings, paintings, sculptures, or any work of art is regarded as capital assets, whether it is used for a personal purpose or for a business purpose. Well, coming to the nature of capital assets, they're of two types. You have a long-term capital asset and a short-term capital asset. The classification is based on the period of holding. That is basically the time from which you purchased the capital asset till the time you're selling the capital asset or transferring the capital asset. As you can see in this particular table, different holding period is defined for different classes of assets. The most notable asset, of course, here is immovable property, be it land or building. And for immovable property, if the period of holding is more than 2 years, it is termed as a long-term capital asset. And if it is less than or equal to 2 years, the capital asset is a short-term capital asset. So if you're holding a building which was purchased 3 years back, and today you want to sell or transfer the building being a capital asset will be falling under the category of long-term capital asset because the period of holding is of course more than 2 years. In the next part, we will understand the main reasons for this classification of long-term and short-term capital asset apart from the period of holding and the mechanism of computing capital gains. So we have understood what is a capital asset, and now we'll try and understand how to compute capital gains. Well, before we do that, it's very important to note the fact that capital gains will be chargeable or liable to tax in the year in which the capital asset is transferred or sold. Say, for example, I have a capital asset and I'm selling the capital asset today, that is 3rd October 2020, and there arises a capital gain. My gain would be chargeable or liable to tax in the year 2020-21, which is basically the year in which I have transferred the capital asset. Well, all of us have heard and accepted the fact that profit is equal to selling price minus cost price in our childhood days. In capital gain computation also, we apply the same concept. To understand the computation further, let's take the help of an example. As you can see, the asset in question is an immovable property, a building, and it is of course a capital asset. The selling price of the building today, that is 3rd October 2020, is rupees 10 lakhs. Let's take two cases. In the first case, the same building was purchased exactly 3 years back on 3rd October 2017 for rupees 3 lakhs. And in the second case, the same building was purchased exactly 1 year back on 3rd October 2019 for rupees 4 lakhs. Now let's start to compute capital gains. Well, in the first case, the selling price is rupees 10 lakhs. When it comes to the cost of acquisition, 3 lakhs was the cost of the building exactly 3 years back. Now sitting today, you want to compute capital gain for the running year 2020-21, and therefore there's a need for you to find out the adjusted cost of acquisition of the purchase cost in order to find out the correct capital gain. And therefore, we need to factor in the element or the portion of inflation into the purchase cost in order to find the adjusted cost of acquisition. And for this particular purpose, the government has provided us with something called as Cost Inflation Index, or CII, for every financial year. And using this particular index, we can calculate the inflated cost of acquisition or the adjusted cost of acquisition. So therefore, as you can see, rupees 3 lakhs is the original cost of the building purchased 3 years back, and this is multiplied by the cost inflation index of the year in which the asset is transferred or the building is transferred, which in this case is financial year 2021, divided by the cost inflation index of the year in which the building was initially bought, that is financial year 2017-18. So with the help of this formula, we can arrive at the adjusted cost of acquisition, which is rupees 3,31,985, and therefore the capital gain or the profit that arises is rupees 6,61,015. Now the question here is, why is this gain or profit a long-term capital gain? Well, building, which was a capital asset, is termed a long-term capital asset in this case because, as you can see, the period of holding is more than 2 years. It was purchased 3 years back, and therefore the period of holding is of course more than 2 years. So any gain arising from a long-term capital asset is of course a long-term capital gain. Coming to the second case, the selling price still remains rupees 10 lakhs. The purchase cost or the cost of acquisition, in this case rupees 4 lakhs, and the gain or the profit that rises here is rupees 6 lakhs. Again, the question here is, why is the gain a short-term capital gain? Because in the second case, the building is a short-term capital asset as the period of holding is less than 2 years. So this benefit of indexation, that is basically factoring in the element of inflation to increase the cost of acquisition and thereby reduce capital gains, is only available to a long-term capital asset and not to a short-term capital asset. And therefore, this is one of the reasons why there is a differentiation between a long-term and a short-term capital asset. Well, coming to the different tax rates applicable for both long-term and short-term capital gains. In the case of long-term capital gains, on the sale of listed equity shares, the rate of tax is 10%. And because of this lower rate of tax, the additional benefit of indexation for this type of long-term capital gain is not available. In cases of other types of long-term capital gains, the standard rate applied is 20%, and the benefit of indexation is definitely attached to it. Well, coming to short-term capital gains, the rate of tax is 15% in the case of transfer of listed equity shares, and in case of all other types of short-term capital gains, the tax rates is dependent on your normal income tax slabs. Let's say you have some amount of capital gain arising from the sale of your capital assets. Now you may very well want to pay low capital gain tax or no tax at all. There comes in the role of capital gain exemptions, which in one way is a form of tax planning, where you can play within the four corners of the law and thereby pay low capital gain tax or no tax at all. There are overall 10 sections for capital gain exemptions in the Act, and because of the paucity of time, we will only discuss two of the most common and the most famous sections, Section 54 and Section 54 EC. First, Section 54 deals with the investment in a residential house property. What it says that if you're willing to sell one property and buy another, wherein you encounter long-term capital gain on the sale of the first house property, the section says that you can get capital gain exemption provided you purchase or construct the new residential house property within the specified time as mentioned in the section, and the exemption that you can get is the lower of the capital gain, which is long-term capital gain already computed, or the amount that you have invested for the new residential house property. Well, a rider in this section is the fact that the lock-in period is 3 years, which basically means that the new residential house property cannot be sold or transferred within 3 years from the date of its purchase or construction. On similar lines is Section 54 EC, which deals with investment in bonds. What it says is that if you have long-term capital gain from the sale of, say, a piece of land, the section says that you can get capital gain exemption if you invest an amount in bonds which have a maturity period of more than 5 years. And this investment that you have to make should be within 6 months from the date of transfer of your capital asset, in this case being land. The exemption that you will get would be again lower of the capital gain already computed, or the LTCG, or the amount that you invested in bonds. But the maximum exemption that you can get is rupees 50 lakhs. Again, the rider here is the fact that the lock-in period is not 3 but 5 years now, which basically means that once you acquire or purchase the bonds, you cannot sell the same within 5 years of its acquisition. I hope I was able to make things clear through this particular video. If you like the video, please do show your support to us by hitting the like button. If you want to become a member of this channel and receive notifications by way of informative videos like these, please do hit the subscribe button. Also tap on the bell icon on the side if you want to receive notifications at a faster rate. I've also given the link to my previous video on gift tax, so if you want to check out the video, please do click on the link. And I've also given my email ID in the description box below in case you want to get back to me for queries or requests. And finally, I would love suggestions coming in for this particular video by way of comments. So I'll see you guys in the next video. Till then, it's a thank you from my side. Have a great day, and most importantly, stay safe.